You just opened your bank app and saw a number that feels different: a raise, a bonus, a new client deposit, or a negotiated rate finally reflected on payroll. Imagine Zara. She got a $10,000 raise and immediately bought a new phone. 6 months later, she was still living paycheck to paycheck. Now, meet James, who treated his raise like business revenue, acting as the CEO of his life. He tripled his savings in the same time. Which story do you want to tell? This moment holds real power, yet most people respond one of two ways. They either upgrade their lifestyle, a flashier car, a nicer apartment, or tuck the surprise away vaguely as savings and carry on unchanged. Both reactions waste your most powerful financial lever: marginal income. If your income just increased, treat every extra dollar like business profit and act like a CEO. Here's exactly how to make that decision non-negotiable. Measure the real raise. A $10,000 raise sounds great, but it's not what lands in your pocket. With a 35% tax rate, that nets about $6,500. This isn't a loss, it's information. You now know your real cash flow increase: $833 gross per month, $541 net. Plan with the net. Think of this net like new profit in your business account. Stop lifestyle creep. Hold your baseline firm. Picture your household as a small company. Would you let costs spike immediately after revenue grows? Probably not. If you earned $100,000 and spent $70,000, your freedom margin was $30,000, or 30%. Now, income hits $120,000 and expenses stay $70,000. Your margin jumps to 41.7%. That's freedom. But if expenses rise with income, you trade future freedom for present consumption. Lock down expenses for 3 months. Feel the difference between fleeting thrill and lasting freedom. Allocate for maximum return. Every dollar you don't spend should earn the highest risk-adjusted return. Carry 18% APR debt? Paying it off is a guaranteed 18% return, beating the market's average 7 to 8%. A $10,000 balance costs $1,800 a year in interest. Investing $10,000 at 8% returns $800. The math is brutal. Pay high-interest debt first. It reduces risk and boosts your bottom line. Debt-free or low-interest debt? Prioritize tax-advantaged accounts next. Maxing retirement accounts isn't glamorous, but it's efficient. A $5,000 pre-tax contribution saves taxes now and compounds tax-free for decades. Automate contributions so capital flows without effort. Treat your raise as an automatic capital allocation event, not discretionary spending. Split your raise: protection, deployment, and controlled lifestyle. Divide your net raise into 3 buckets: protection, deployment, and controlled lifestyle. Protection covers emergency funds and insurance. Deployment means investments that grow optionality. Lifestyle is a small, intentional uplift so you don't feel deprived. Rule of thumb is 30 to 50% deployment, 20 to 30% protection, and 10 to 20% lifestyle. For $416 net monthly, about a $5,000 gross bump, that's $200 to $300 invested, $80 to $125 for liquidity or insurance, and $40 to $80 for lifestyle. Maintain this for at least a year and watch how small, steady allocations compound into real wealth. See the power of compounding. Invest $416 a month at 8% annual return for 30 years, and you accumulate roughly $621,000. Steady action, not luck. Add $500 a month for 20 years, and you gather about $295,000 more. These aren't empty promises, they're the math of marginal income turned into real optionality over time. Build your optionality buffer. Optionality capital is money kept accessible but not spent. A 6-month emergency fund, a cash reserve for business ideas, or funds ready for opportunity. It's not hoarding, it's buying the right to act. When a real opportunity appears, a partnership, a rental down payment, or a relocation, you can say yes instantly. Aim for 3 months of essential expenses, scaling to 6 if income fluctuates. This safety net is your freedom insurance. Tune your earnings engine. Think of your earnings engine like your personal money machine. Margin, leverage, and reach are dials you adjust. Margin is the gap between income and spending. Leverage means using systems, capital, or teams to amplify output. Reach is your audience or distribution. Spend part of your raise to tune this engine. Courses to boost rates, software to automate, hires to free time. Treat education and experiments like capital expenditures with expected returns. Fund the highest upside projects first. Optimize taxes and review protection. Don't ignore taxes, but optimize. A $10,000 raise at 35% nets $6,500. Redirect some into pre-tax retirement to reduce taxable income and grow invested capital. Employer matching? Capture it. It's free money. Income rises? Review your disability insurance. Protection for your human capital. Replace income in bad years costs far more than premiums. Tie this to your protection bucket and revisit beneficiaries and estate plans if finances change. Rebalance asset allocation. A raise changes savings rate and risk tolerance. If your target is 70-30 stocks bonds, keep new contributions aligned. Planning near-term purchases? Keep funds in low-risk, short-duration assets. Match contributions to goals, not habits. Master the psychology of spending. Small lifestyle upgrades feel good and keep you motivated, if intentional. Allow a 10% fun allocation so the raise feels like progress. Anchor the rest in freedom-building systems. Small consumption buys happiness now. Capital deployed buys freedom later. Sell yourself the future each time income rises, or risk waking up years later trapped in the same tension. Track your progress. After reallocating, track 3 monthly KPIs. Savings rate, savings divided by gross income, emergency runway, months, and optionality cash. A $120,000 earner saving $50,000 annually has a 41.7% savings rate, a stronger predictor of freedom than salary alone. Raise your savings rate, raise your freedom structurally. Run quarterly experiments. Treat the first 3 to 6 months after a raise as a test. Did allocations reduce volatility, boost investable capital, and create options? Did you feel deprived? If yes, scale up. If no, tweak your plan. Compounded decisions require measurement. One well-allocated raise changes your trajectory more than 10 spent on autopilot upgrades. Your income just increased. Here's your checklist. Calculate net new cash, hold your baseline firm for a month, split net across protection, deployment, and lifestyle uplift, pay down high-interest debt, boost pre-tax retirement if available, and build optionality capital. A $5,000 gross bump, about $416 monthly, about $300 net, invested at 8% for 30 years becomes roughly $620,000. A $10,000 bump taxed at 35% nets $6,500, enough to kill debt, build optionality, and enjoy a small reward. Treat every marginal dollar as a soldier in your financial army.